Well, hello and welcome to the Overnight Edge. In this episode, we're going to be discussing why are health insurance premiums so high. And what we want to address or investigate, which I was really surprised when I investigated this. I kind of had an idea, but when I dug into it, I was like, whoa, you're going to see. You're going to be with me in just a second. So, why are health insurance premiums so high? I'm going to give you one answer. It's called the Affordable Care Act. The Affordable Care Act is the reason your health insurance premium is so high. And if we're going to discuss the ACA, let's do a little bit of background. It was passed in 2010. Major provisions did not take effect, however, until 2024. And major supporters, you're going to recognize many of them. Many of the individuals who were really pushing for the Affordable Care Act, we'll see. American Medical Association, American Hospital Association, Pharma Research and Manufacturers Association, believe it or not, were interested in the Affordable Care Act. AARP, many unions were also interested in pushing the Affordable Care Act. Service Employees International Union, the AFL-CIO, teachers, pretty much every teachers union was pushing for the Affordable Care Act, and now our insurance premiums are so high, we just going crazy. National Education Association, American Federation of Teachers. So, how did the Affordable Care Act increase prices? Let's get to the guts of this conversation here. 3 ways. Number 1, it removed product competition. Number 2, it set insurance company profit. And number 3, it subsidizes. That means the government pays for health insurance premiums. Well, how did each one of these items increase your health care costs, your health insurance costs? Let's see. First, let's discuss the removal of competition. What the Affordable Care Act did was basically it mandated that all policies must cover essential minimum items, essential minimum coverages, I guess you would say, or essential minimum benefits. All policies must cover this. Insurance must provide these coverages regardless of the age or need, and consumers, such as yourself, must buy these coverages regardless of however old you are and whether or not you need these coverages. So every insurance policy, basically, you got one big insurance policy and you got a couple companies that are divvying them out and they're all selling the exact same thing for the most part. So what you must buy, here's your essential minimum coverages or benefits: ambulatory patient services, basically that's doctor visits, emergency room services, hospitalization, maternity and newborn care, mental health and substance use and disuse, disorder, I should say, prescription drugs, rehabilitative services, laboratory services, preventive chronic disease management, and pediatric services, including oral and vision care, whether or not you're in a market or the age where you need these items, you're paying for them, whether you want to or not. Also, you must also pay for coverage of pre-existing conditions. Now, that might be helpful if you have one, but that means you're also paying for someone else's pre-existing conditions. You're paying not to have a limit on the amount paid by the insurance company for those covered items I just mentioned, whether you need that or not. You're paying for it for yourself and for everybody else. There's also a cap on out-of-pocket costs that any individual with those 10 essential items, it caps the amount that they have to pay for those. So basically your co-pays and whatnot. So it's a cap on out-of-pocket cost, whether you need that cap or not. You're paying for it for other people if you don't need it. Coverages for dependent children up to age 26. You're paying for that whether you have any children or don't have any children. All right. So let's go to an analogy corner here. All right, Randy's car dealer. There's Randy right there. You might recognize him because I don't understand copyright laws. I'm using pictures. All right, so there's Randy. Randy sells a variety of cars to a variety of buyers, or well, maybe he used to. He doesn't anymore. But he likes to sell Corollas. So your new families, someone's fresh out of school, someone's out of high school. It's a lower, really reliable car. Super reliable. I love the Corolla. But it's a lower price car, very reliable car. He also sells Expeditions. So maybe you're moving up and you're a family member. You got a little bit more money. You can afford a more expensive car. You got your Expeditions there. It's got full-wheel drive. Very, very nice car. And he also sells the top of the line, one of the most expensive cars on the market, the Corvette ZR1. And it is super, super expensive and super nice. Luxury sports car. There you go. Now, the government comes along and tells Randy, the government says, hey, Randy, guess what? You can no longer sell Corollas and Expeditions. These items are gone. Get them off, get them out of the parking lot. Get them off the lot. You can no longer sell Corollas. You can no longer sell Expeditions. You can only sell the Corvette ZR1 to everybody, whether they want one or not. That's all you can sell. And these are top of the line, super expensive, very, very nice vehicles. But that's all you can sell anymore. Does this sound familiar? All right, got a couple questions for you. How can Randy compete if he can only sell one very expensive product? Well, fortunately, he doesn't have to compete a whole lot because guess what? All the other dealers can only sell one car. They're only allowed to sell one car. Kind of sounds like something, doesn't it? That's called a command economy. But anyways, they can only sell one of the most expensive products. So how can Randy lower prices? How can he? Really? He's only allowed to sell one car. He can't lower prices if he wanted to. Maybe he can cut his overhead a little bit, but he has no control over the price of that car. He gets it on the lot. He's moving it through. He's going to mark it up so he gets a margin. That's how it works. So is the industry gone? Is the auto industry, if no competition, they only sell one product, is it really even an industry anymore? Or is it really just a, front door for the, for the insurance, for the government, basically? All right. This is the same with insurance companies. Let's do a little bit more of an analogy here. Jack's healthy. He's 28 and he only needs Corolla coverage, but he must buy Corvette ZR1 coverage. Of course, he can't afford it. So how is he going to afford that ZR1 Corvette with that ZR1 coverage? He doesn't need it. He has to buy it. How can he afford it? That's where your subsidies come into play that we'll discuss momentarily. So the Affordable Care Act removed product competition, forcing insurers to sell and customers to buy the most expensive policies, which many, many do not need or and do not want. All right, let's move on to the second way the Affordable Care Act wrote increased prices or very much incentivized the increase of prices. It set insurance companies' profit. Now, they call it a cap. Yeah, it's kind of more of a guarantee. All right, so what it did was it set the gross product. A little bit of background here for folks who own stocks. If you're sitting on the board of directors of a company, you have a fiduciary duty to act in the shareholders' interest. It's not a law, but it is a duty. And if you want to increase the stock price or keep your job, you want your shareholders happy. And what do they want? They want increasing returns on their investment. So what the Affordable Care Act did, it requires insurers to spend 80% of their individual and small group premiums on health care, on medical claims and related items. Now, if you're in a large group or the large group market, they had to spend 85% because the theory is their costs would be a little bit lower for the larger groups. All right, you with me so far? All right, this leaves a 15 to 20% guaranteed gross margin for the insurance companies. That gross margin is also called gross profit. They call it a cap, but if you're on the board of directors, guess what? It's a guarantee to you, and you're going to get as close as you can, as often as you can. So this gross profit covers your administrative costs, which you can control a bit, your overhead, which you also have some control over, and then your profits, what's left over. However, the Affordable Care Act, listen to me, does not limit the amount the insurance companies can pay for medical care. The amount they pay for medical procedures and whatnot, it does not limit how much they pay for what they're spending on medical procedures, prescription drugs, anything. There's no limit on that. The Affordable Care Act does not limit that. So I'm going to highlight it again and say it out loud. Once more, the Affordable Care Act does not limit amount insurance companies pay for medical care. That creates an incentive that I'm going to discuss right now. What's the easiest way to increase profit under these conditions? You pay more and more for medical care and procedures. It's going to increase your profit. Now, when you're paying more, I'm getting ahead of myself. All right, get excited. All right. Here's the formula. Higher medical costs. Now, if you're paying more for those medical costs, And the people who's providing that medical care, you follow me? They know you're going to pay more for it because you're incentivized to. Then if I'm an insurance company, I'm going to use those higher medical costs to go to the insurance regulators and say, hey, look, these medical costs are going up. I need to increase my insurance premiums. So higher medical costs lead to higher insurance premiums, lead to higher gross margin. That results in a higher profit and higher shareholder value. Now my shareholders are happy. I'm on the board of directors. Woo! All right. Let's move forward with an example here. Increasing profits. How are we going to increase profits? We can add a lot of zeros to these, but I'm going to keep it simple. Insurance premiums, let's say your insurance premiums to your company are $1,000 a year. Your medical payouts are $850. That leaves a gross profit of 15% or $150. You've got administrative costs and overhead, which you have some control over, of $50. So that leaves you with a net profit of $100. So what's the easiest way to increase profits in this scenario that we discussed a moment ago? Is to increase medical payouts, the $850. So let's increase these payouts. Let's say we increase these payouts by 10%. Now they're $935. That increases our premiums. Hey, we're paying out more. Medical costs are going up, guys. Mr. Regulator, we got to increase our premiums by 10% to cover that increased cost. You said, we get this. We get a 15% margin. All right, so we got a gross profit of 15%. That's $165. We got administrative and overhead of $50. We can control that. You'll notice that number did not change, but guess what happens because we have control over those administrative costs? Our net profit just increased by 15% to $115. Higher medical insurance costs justify the increase. There you go. Look, our medical costs are going up. We did increase those premiums. And we just increased profit by 15%. Not rocket science, basic math. All right, let's move on to number 3. The third way the Affordable Care Act increased health insurance prices is the government subsidizes. That means it pays for many, many individuals' insurance premiums. I'm not going to get into math of how it works. You can look that up. Maybe another overnight edge, we'll discuss that. And the reason we're discussing this, just to back up a little bit, these subsidies are mainly tax credits. So it flows through your tax return. You don't get the credits, though. The credits go directly to the insurance company, but if you no longer qualify in the year, guess what? You may have to pay those premiums back. But I digress, so let's regress. Let's get back on here. All right, here's what subsidies do. In general terms, inflation is created by the printing of money. So when you print money and you throw it into the economy, that basically devalues all the products and services you're getting, which means inflation, it devalues the value of your dollar. So now you're paying more for the items you purchase. The Inflation Reduction Act spent a lot of money. That's what created the inflation, just so you know, that we are now trying to get out of. All right, so printing money through the economy creates inflation. But what if you basically don't necessarily print money? You just throw a bunch of money at a particular product or service. Same thing. Except now you're more focused. You're focusing on one product or service, and you're going to increase those prices of that particular product or service. Again, basic math. You're not increasing supply, you're increasing demand and keeping supply constant. Subsidies increase price. Once again, subsidies increase price, as the famous Thomas Sowell says. I'm paraphrasing this. He might have said it, but I keep finding it. I've read a lot of his books. Great guy, by the way. Great economist. Nothing skyrockets prices quite like the government saying they'll help subsidize it. Thomas Sowell, economist. All right, increases prices. Technically, as I mentioned a minute ago, what happens is you increase demand, you don't increase supply. Anytime you increase demand without increasing supply, you push prices up. But you're also just pumping money into that product or service. So you're devaluing those dollars because you're increasing the cost of those services. All right. No more technical mumbo jumbo. Let's go. All right, here's a few examples. Daycare. Why is your daycare so expensive? Part of the reason is the tax credits that you get for your daycare, and also many, many programs that subsidize daycare. And at the same time, let's not get into it, you got a ton of increasing regulations on daycare providers, which increases costs. So you got a double whammy with daycare. College tuition. Student loans didn't exist 20 some years ago, or existed minimally. You can track the increase of tuition almost dollar for dollar or percentage for percentage with student loans that go out there. And also the grant programs have a lot. Food products, agriculture subsidies, housing vouchers, and tax credits also can increase the cost of housing. Health insurance, what we're discussing today. Affordable Care Act, these subsidies act as tax credit to the taxpayer. However, they go directly to the insurance company. All right, let's go through another example here. Randy's got some Snickers bars. Randy's selling Snickers bars. He's the Snicker bar guru. I think that's Mars that does a Snicker bar. I'm choosing Snickers because I love me a good Snickers bar. All right, but Randy's selling Snickers bars for $1.75 a piece. And of course, you got Andy here. He's only got $1.25. He cannot afford his Snickers bar. Barney's in the same boat. He's only got $1.25. How is he going to get himself a Snickers? Otis. $1.25. No Snickers bar for you. Well, the word gets out. The word gets out that, hey, these guys really, really deserve a Snickers bar. So Uncle Sam comes to the rescue and he says, I want you to enjoy a Snickers bar. By the way, this is not an endorsement for Snickers, but if Snickers wants to call me and become an endorser, that would be great. I just like me a good Snickers bar. All right, so Uncle Sam, then he goes forward. He says, I will subsidize your Snickers bar. I will give you each $1,000 to buy a Snickers bar. So guess what? Andy gets $1,000 for a Snickers bar, but he's got to pay that money. He's got to spend it on that Snickers bar. All three of them. Barney gets one. Otis gets another $1,000. So all of them got $1,000. So now look. Andy, Barney, Otis each have $1,001.25 to spend on a Snickers bar. However, poor Randy over here, he's only charged $1.75. You think he's going to keep charging $1.75 when he knows that the government subsidized him $1,000 and he knows that Andy's got each of these guys got $1.25? You think he's going to do that? No. He is going to raise his price to $1,001.25 because he knows that's free money. That $1,000 just created a floor on which prices will then rise. Isn't that cool? So why are insurance premiums so high? To wrap this thing up, the Affordable Care Act increased prices. It was a price increase caused by the Affordable Care Act. They removed product competition. You can only sell the most expensive product. They set insurance company profit percentage and incentivized them paying more for care, which as a result increases profit. You're going to increase those prices, they increase profit, don't you? All right. And finally, it threw fuel on all that by subsidizing, the government pays for the most expensive product that now has ever increasing premiums, partially because of the subsidy themselves. Isn't that great? All right. Hey, you got a question or comment? I know you're probably going through your own horrible experience with your health insurance, but also, maybe you got your own comments, your own theories. Share them below. We'd love to hear from you. Check out our playlist for more tax and business tips. Also, if you're really interested in growing your business, cutting your taxes, check out Overnight Accountant. Take a deep dive into one of our courses.